It's Brian Preston, the money guy.
Avoid the herd mentality. It drives me crazy, but it's just the nature of the industry and the way money works because they're totally playing off of our emotions. I did this on purpose, and you'll see why I'm going here, Bo. This is a headline from January 15th of 2016.
Okay.
U.S. stocks post the worst 10-day start to a year in history.
Oh, no.
In history, stocks posted the worst 10-day start. I mean, do you remember this? We lived this, and our clients, we're doing this on purpose for you guys. We're kind of taking a walk through history, guys. Does anybody remember the rest of the story? Because here's what happened from January 4th of 2016 and all the way to January. It was around January 20th or so. The market lost 11%.
That's a pretty substantial drop inside of just a few weeks in 1 month.
So you hear that and you're like, okay, the market's down 11%. There's no historical time that's done that. It probably was a disaster for the rest of the year, right?
Sure.
Because there's also this anecdotal thing that however January goes, the rest of the year follows.
That's right.
There's people that believe this stuff. That's what's crazy. So I got another little side, and all of our clients are like, oh gosh, he's pulling it out. Because we use this one on our quarterly commentary a pretty good bit. This is talking about intra-year volatility, meaning that every year, because we know this from markets get reported at the close of December 31st. And everybody looks back from January 1st to December 31st, and they tell us if it's a positive year.
That's right.
And that's what we forever remember that year about.
And maybe you've heard some statistics that the market makes, like 10 or 11% on average. Most of the times, it's not just making a steady, nice little 10% every single year, year in and year out. That's not the way it works.
Well, we've talked about, because we've done it on other shows, is that it's close to 78. I think it's around 78%. If you just looked at the stock market on a year-over-year basis, it's about 78% of the time it's positive on a one-year basis. But that's only part of the story,
Right.
and this is why we show this chart. On average, every year, despite the fact that it's up usually 78% of the time, every year there's an intra-year drop of 13.8% of 29 of the last 38 years.
And I just think about if I was an investor sitting there and someone said, hey, how would you feel about losing 13% in a year? You'd be like, oh, that sounds awful. No way. Don't sign me up for that. But what if someone said, how would you feel about losing 13% in a year where you made 8% over the entire year?
Well, take this case study of what I just talked about. January of 2016, all the headlines are saying this is the worst in history. Market's down 11%. And by the way, there's our confirmation on my chart. It's down 11%. There's the dot down there at negative 11. But wait a minute. The year actually ended up being positive by 10%.
Yep.
So I'm telling you all this is because a lot of you guys are watching this stuff now, and you're closing out 2018, we're in 2019, but this is going to carry on for years afterwards, and I want you to know the advice doesn't change. I'm going to get into more specifics later, and it's so funny how I give the same advice over and over again. I just update the data, and the data doesn't change
That's
a ton either. This is behavioral, and if you want proof that it's behavioral, look at this. I love this, and I did a little shock and awe. So you see this, Bo?
I see it.
You see how it has no web things or anything else on it? You know what I did?
I have no idea what you did.
So Carl Richards
Behavior
does
Gap?
these little, behaviorgap.com does these little cartoon type things. I bought this.
Oh, nice.
He sells them on his website.
Okay.
So we actually own a digital version of this that we could blow up if I wanted to fill up the wall with this so that people would get the idea.
Thank you, Carl.
I thought you'd be mad at me because you're such a tightwad, but I wanted to do Carl right in the fact that he came up with this, and I love it because we always show the cycle of market emotions. And, and just real quick to repeat the cycle of market emotions, people, when you're making money, they think they're brilliant, they get excited, and that's
There's
the
some thrill
cocktail
to
party. Yeah, it totally feels like, man, everybody should be making money, and that's when that greed is kicking in. But then we go through the market cycle, and the market starts going down. People start freaking out. They get, they get desperation. They get fear, panic. Oh, my God, what have I done? I'm never investing again is what they think when they get to the bottom of it, and that's usually when they sell. But I always like to point out that up here where things are rocking and rolling and great, that's the maximum point of financial risk. At the bottom of it is the maximum financial opportunity, But what is the reality of the emotional situation of the average investor is they do what Carl talks about, is that here's the greed and here's when the buy indicator kicks in.
That's right.
So let's buy this thing. It's good.
All your friends are making money, so you got to get in.
Starts getting a little bit of a hiccup, some fear. Let's get out of this thing now.
I've lost everything. I got to get out.
And then we repeat the process until we're broke.
Yep.
That is the herd mentality, if I could summarize it. And I get it. Look, the news media is sensational. Their headlines, if they're designed for anything, it's to create an emotional reaction. So you keep your eyeballs on, whether it's print media or whether it's the TV.
Yep.
They need your eyeballs there so they can sell ads and they can keep making money. So I get why they're doing it. Unfortunately, you guys are reacting to it. You're kind of, instead of being creating a financial plan, an investment allocation that reflects your long-term plans, your risk profile, what age you actually want to reach some of these financial goals, you're reacting to these things, and that's usually the worst time to make these type of adjustments. And you put a Warrenism in there. What do you mean by these?
I think anytime the market freaks out, one of the things we can always do is we can think about, well, what does one of the greatest investors of all time say about this thing that we're happening? And I think that Warren Buffett says it fantastic. He says, you always want to make sure that you are fearful when others are greedy and greedy when others are fearful. So if you want to set yourself up for success and avoid the herd mentality, you got to kind of take a measure of the temperature around you. And is this a time when people are greedy and I should be fearful? Or is this a time when people are fearful and maybe I should capitalize on that opportunity?
That's easier said than done.
Oh, yeah, for sure.
Because emotionally it feels hard to want to take advantage of a really good downturn in the market.
Right.
So, but that is, I love what Warren Buffett always puts out there. But let's actually put some analytics to this thing. So we've talked about be careful of the herd mentality, but let's talk about missing the best days. Because a lot of people think, well, the emotional compensation comes from if I just get out, it will stop the pain.
That's right.
And the cautionary tale I will tell you, whenever people tell me they just want to get out to stop the pain, you're not really stopping the pain. Because here's what's going to happen. I can predict it. Is that it will temporarily give you some relief, but the problem is when recoveries start to happen, you've exasperated and extended the pain because now you're like, oh my, I missed it. I missed it. Because remember, markets usually, economies are growing, markets are growing, and missing the best days can be costly. So let's kind of talk about this. There's always temptation to want to get out. And I love that Fidelity Investments keeps updating this research study that they've been doing really since 1980. It's January of 1980. They invested $10,000, and they like to show how much that money grew. By the way, if you're curious, $10,000 invested in 1980 would grow to be all the way up to 700. I'm missing my number. Was it $708,000?
Yeah, I think it was right around that.
So I loved how the fact that it was that $10,000 investment in 1980 all the way through June 30th, June 29th, I believe to be exact, of 2018. That's the most recent data. It grew tremendously.
That's right.
But here's the rest of the story. If you missed the best 10 days, if you missed the best, why can't I say that? You missed the best 5 days, 10 days, 30 days, and 50 days, you gutted your performance.
So over that entire period, if all you did is you just accidentally were out of the market for 5 days, for 10 days, for 30 days, or for 50 days, it dramatically affected whether you got that big multiplier over the whole long term.
Over 37 and a half years. I actually calculated it out because there's about 9 trading holidays each year. So if you looked at how many trading days are available, that's approximately 9,400 trading days in the financial markets.
Okay.
So let's hear what these numbers did. If you missed the best 5 days, it actually drove your performance down 35%.
Wow.
If you missed the biggest 10 days, your performance dropped by 52%.
So just 10 days out of 9,400, is that right?
Yes.
Cost you half of your return over that entire life cycle.
If you missed 30 of those days, of the biggest days, you lost 81%.
So roughly 1 month over a 37.5-year period could have cost you 80% of your upside.
And I even put, I mean, it was so interesting because these aren't even, when you say rounding errors, I mean, 30 days is like 0.3, 50 days is like 0.5 of 1%. I mean, we're not even talking about 1%. So you'd have to get it right That's just unbelievable odds.
Yep.
And if you missed 50 days, it's 91% of your return got gutted.
Unbelievable.
So a lot of you, there's going to be some trolls, some knuckleheads out there going, well, wait a minute, that's one-sided. If you could miss the best days, it probably cuts the exact opposite way too. If you miss the worst days, it would also be awesome. Yeah. And that is a true statement. However, we all know markets are up much more than they're down, meaning that the progression year over year of the financial markets, and that makes sense because the economies are growing, you got innovation, you got all kind of positive things. I think it would be much harder to pick the days because you are getting into a timing situation of trying to avoid those worst days. Whereas the point of why I'm sharing this data is, and it's that old quote, it's not timing the market, it's time in the market. Exactly because you know what? It's easy to do our strategy. If you just stay focused, stay invested that 37 and a half years, the market lets the assets do the work for you. So you're not working with your back, your hands, your back. The money is working for you. And here's another thing. It's an echo of something we've talked about on a lot of shows, Bo. I tell everybody, I get so excited that 20-year-olds have the opportunity to go invest in something like the S&P 500 when they're 20 years old. And if you put $1,000 in, by the time you retire at 65, so that's approximately 45 years, it has a chance to probably be worth about $88,000. Yeah. So it's 88 times over growth. Look at how much this, I thought this was an awesome thing that 37 and a half year period, the money had grown 71 times over.
Yeah, so it's
right on track to that same 88 that I was talking about. It's nice that it's not only a theory of a calculation that I've provided our listeners and our clients, it's also what history shows by just staying invested in the financial markets.
I think what you have to remind yourself, and we've talked about this before, Brian, is that volatility is uncomfortable and it doesn't feel great when the markets are going down and when they're misbehaving. But we use this analogy all the time. You and your wife cook a lot at the house, right?
Sure.
Sometimes investing is like when you reach out and you touch a hot pan, right? And you get a blister on your finger. And it's like, oh my gosh, that blister really, really hurts. Selling at the bottom or getting out would be like just cutting off your finger. Yeah. You're coming up with a very permanent solution for a very temporary problem. So you have to think about it in those terms. Volatility is sort of this temporary thing. How does that fit into the long-term context of what I'm trying to accomplish? And I think, again, going back to Warren Buffett, he has a fantastic Buffettism. He says, doing reasonably well investing in stocks is very, very easy. Buy a low-cost investment, preferably over time, dollar cost average, so that you end up owning good businesses at a reasonable average price. That's all you have to do. He didn't say buy at a super low price, buy the best company, invest in the best thing. He said just do it and do it consistently over time and be in the market, and it's not that hard to be successful.
And dollar cost averaging is an opportunity. It cuts volatility. That's why I love, we have some financial mutants that are in our client base that whenever markets get beat up, instead of looking at the glass half empty, they look at it as glass half full and actually try to find more money because they know that this is a great time to potentially pick up even more.
Exactly right.
Great valuations.